out. Let's get some perspective on these European markets, valuation and so forth with James Demmert, Chief Investment Officer at Main Street Research. Thank you so much for your time this morning. So how do you view these European markets? We're up by roughly 7% year to date, similar to what the U.S. markets have delivered, but there's so much risk ahead, obviously, when it comes to tariffs. So how active do you want to be here when it comes to risk?
Good morning. I think investors want to obviously consider risk, but don't put that too far in front of you. As we've seen in the last few quarters in Europe and also in the U.S., earnings have been way better than expected. I think investors really need to sort of put away the fears a bit and focus on growth and earnings. It is a new world order, is what we call it, and monetary policy in Europe is much more stimulative than it is in the U.S. So we think Europe is really attractive.
What about specific industries or stocks? What are you looking out for?
Well, I think that's where you really want to be careful, right? If you're looking at fiscal and monetary stimulus in Europe, which is what we see in significance, much more than what we've seen in the last 10 years, the sectors you're going to look for instance, are the banks. The financials are a really great place to be as rates come down and productivity growth with AI continues to increase. The banks should be a great place to be. I think the industrial sector absolutely would be a wonderful place to be as infrastructure builds out throughout Europe. And of course, we have to play the AI. This is a revolution, evolution in AI, and there's lots of great opportunities to do that in technology stocks here in Europe, but also in companies that are related to the AI, for instance, as the energies play. We need more electricity to drive crypto, AI, and all of these things. So lots of opportunities, and valuations are compelling.
What's going to be the next catalyst? Because, certainly all those things that you just described are valid. They have merit. They're appealing here. But they're also pretty well understood now by the market. And we've seen a lot of the positivity play out in some of these sectors, in industrials, in banks already year to date.
I think people think this is, the rally has ended. And I have to remind them, as a global investor, most investors around the world are under-allocated to Europe. And I think the next catalyst, to be honest with you, is valuations are so cheap, earnings are going to continue to be well, and you've got a lot of money that needs to come back to Europe. I think over the next few months, you're going to get FOMO by a lot of big institutional global managers who are under-allocated to Europe. This could go on for multi-years in our view, and with below valuations, good earnings, you've got a lot of money coming after us. This could be one of those multi-year rallies where the foreign stocks do way better than our U.S. stocks back at home.
Well understood. So this rally could have a lot further to run in your view. James, could the U.S.-EU trade talks derail the European investment case here? The tone coming out of Washington, coming out of Brussels over the last couple of days has turned a little bit more sour as we approach the August 1st deadline.
Yeah, it's a volatile negotiating situation, as we've all watched. I think investors should be careful about using that as I'll not invest. I think you should want to look through the tariffs. The most important thing is that monetary policies, fiscal stimulus in Europe, that's not going to change. That's a longer-term positive element. The tariffs, we will work through those. They'll probably be a little better than expected. It's important, though, investors should stay in industries that maybe not as vulnerable. Like I love the financials like HSBC, Siemens Energy, stay away, a company called Train Technologies. These companies are not quite as vulnerable to the tariffs. I think that's another thing that investors should think about.
James, I see that you're currently, hopefully, enjoying some dolce vita in Italy, in Florence, but I know that you're usually based in the U.S., so let's talk about the U.S. sentiment. Obviously, we're still close to record highs when it comes to the S&P 500. That said, a lot of discussion, a lot of fear when it comes to the independence of the central bank, of the Fed. How much is that going to rattle investors going forward, or is there actually hope that, yes, there is this implicit easing buys by the Fed or the new incoming Fed president, rather?
It's hard not to bring that up when we talk about U.S. markets. And yes, I'm enjoying my time here working and enjoying Italy. I don't think there's any way that Trump moves the Fed out. I also don't think that they're going to push the Fed into lowering interest rates. So investors in the United States need to be sort of complacent with the Fed is going to stay where they are. And they can, because earnings in the U.S. are better than expected, and that's what drives stocks. But keep in mind, the U.S., as opposed to Europe, faces some headwinds. They have a more restrictive monetary policy, and they're trying to cut back fiscal stimulus. So we see a slower growth rate in the U.S., not a recession, because we do have AI tailwinds. We got deregulation, and tax cuts. So, kind of the Goldilocks economy. It's great for stocks in the U.S., but again, be sector sensitive. We don't think the Fed is going to be moved out of the way. I think that's a next June when we get a new Fed chairman anyway.
James, what do you think of the UK? I mean, you talk about how some, restrictive policy, and when it comes to fiscal policy here in the UK, we're all bracing for potential tax hikes come the autumn. The government is struggling to cut back on spending. But you seem to like the UK market. Is this just a valuation call?
I have to say it is a valuation call. I mean, earnings have been better than expected in the companies that we like HSBC. And of course, they got the cost cutting and some other really cool stuff going on with that company. But we like the UK, and it's really a valuation play. It's also a play on if you're under invested in Europe, which many global investors are, particularly in the U.S. That money is going to come, but it's going to follow those earnings. And so, yes, even if there is some sort of headwinds from rates in the UK, we think the earnings and the money that needs to be allocated is going to outweigh that. And we've seen that in many examples around the world where, this potential headwind gets sort of dwarfed by these bigger issues.
James, finally, let's talk portfolio construction. Where do you want to be? How much do you want to be weighted in equities versus fixed income? And what do you do with the alternatives? Where do you go in currencies and some of the safe havens? A lot of questions, not a whole lot of time.
Yeah, well, I'll keep it short. We are bullish. I think this is a global AI tech-led bull market, but it's a global market, and we're about half outside the U.S. We would also suggest that if you have the ability to be 100% stocks and perhaps you have bonds outside, that's fine. But most of our clients, we manage the bulk of their money. They're 70% stock and they're 30% fixed income. And that fixed income is laddered out over 5 to even 25 years because rates we think are very appealing here to lock in. And we're focused mostly on technology and industrial companies, anything that can and will be able to have better earnings. And we use risk management tools like stop losses just to keep us out of trouble. But we think you should be liquid, not necessarily be in alternatives that you can't sell tomorrow. It is a risky world. Stay liquid, use stop losses, but focus on those great parts of the world and those great sectors that have promise.
All right, not quite 60-40, more like 70-30 here. James Demmert, thank you so much for that. He is the Chief Investment Officer of Main Street Research. So